If Warren Buffett started over today with just a regular salary, he wouldn't be hunting for magic stocks. He'd do 3 boring things that actually work: low expenses, index funds, and patience. And the craziest part, he's written that for his own family. He wants 90% in an S&P 500 index fund and 10% in bonds. That's Buffett-style wealth building. If you want to learn the exact strategy that actually works even on a modest salary, smash that like button and subscribe. Because what you're about to learn could change your financial future forever. Warren Buffett, the Oracle of Omaha. Net worth: over $130 billion. But here's what most people don't know. He made his first investment at age 11, and 99% of his wealth was built after he turned 50. Throughout his career, Buffett has revealed exactly what he'd do if starting over with just a regular paycheck. And it's simpler than you think. Watch Buffett's wealth build steadily over decades, slow at first, then accelerating as compounding snowballs. Early contributions plant the seed, consistent investing waters it, and time delivers outsized growth. This is the curve patience creates. Not luck, not timing, just disciplined, boring progress that becomes extraordinary later. First, let's address the elephant in the room. Buffett still lives in the same house he bought in 1958 for $31,500. He drives modest cars. He doesn't wear expensive watches. This isn't about being cheap. It's about understanding a fundamental truth that separates the wealthy from everyone else. If you're starting with a salary today, Buffett's first principle is this: save at least 20% of everything you earn. Not after you buy what you want, before. He calls this paying yourself first. Think of it as hiring your money to work for you. Let's run the numbers. Say you earn $50,000 a year. That's about $4,200 per month. If you save 20%, that's $840 per month or $10,000 per year. Sounds impossible? Buffett would tell you it's not about how much you make. It's about the gap between what you make and what you spend. Your wealth grows in the space between income and expenses. The gap. Expand that gap relentlessly. Track every bill, negotiate cheaper plans, cancel unused subscriptions, cook more meals, and automate savings on payday so money moves to investments before you see it. Then increase income with skills, side projects, and smart career moves. Each month, allocate a fixed percentage to investments first, essentials second, wants last. As income rises, resist lifestyle creep. Keep housing, car, and everyday costs modest. Direct raises and bonuses to investments, not upgrades. Revisit your budget quarterly. Trim, optimize, repeat. The goal isn't perfection, it's consistent positive spread. Even a few $100s more saved each month compounds into tens of thousands, then hundreds of thousands. Growing the gap is simple arithmetic with massive consequences. Wider gap, faster compounding, greater freedom. That's the formula. Earn more, spend less, automate the difference, and let time do the heavy lifting. Here's where it gets interesting. Before Buffett would invest a single dollar in stocks, he'd invest in himself. In a 2017 interview, he said, "The best investment you can make is in yourself. The more you learn, the more you'll earn." But this isn't about getting random certifications or degrees. Buffett is strategic. He recommends 3 specific areas. 3 pillars power your career: communication, financial literacy, and industry expertise. Speak clearly, understand money deeply, and become the go-to person at work. Number 1, communication skills. Buffett took a Dale Carnegie public speaking course when he was young. He credits it with increasing his value significantly. Whether you're negotiating a salary, presenting ideas, or building relationships, this skill multiplies everything else. Number 2, financial literacy. Learn to read financial statements. Understand compound interest. Know the difference between assets and liabilities. Buffett reads extensively every day. You don't need to match that, but spending 30 minutes daily on financial education will put you ahead of 95% of people. Number 3, deep expertise in your industry. Become so good they can't ignore you. This increases your earning power, which increases your investment capital, which accelerates your wealth building. Now we get to the investment strategy itself. And this is where Buffett surprises everyone. Despite being one of the greatest stock pickers in history, his advice for regular people starting with a salary is brutally simple. Low-cost S&P 500 index funds. An index fund is a basket of leading companies, hundreds of brands you already use. Together, they form a resilient base where losers are replaced and winners keep lifting the whole market. Buffett's simple rule for families: 90% into a low-cost S&P 500 index fund, 10% into short-term government bonds. Low fees, broad diversification, and peace of mind. In his 2013 letter to shareholders, Buffett revealed that when he dies, he's instructing the trustee of his estate to invest his wife's inheritance like this: 90% in a low-cost S&P 500 index fund and 10% in short-term government bonds. Let that sink in. The world's greatest investor recommends index funds for his own family. Why? 4 reasons. Reason 1. Diversification. An S&P 500 index fund gives you ownership in 500 of America's largest companies. You're buying Apple, Microsoft, Amazon, Google, Johnson & Johnson, all in one investment. When you invest in the index, you're not betting on one company. You're betting on American innovation and capitalism. Reason 2. Low fees. Buffett hates fees. They're silent wealth killers. An index fund might charge 0.03% per year. An actively managed fund, 1 to 2%. That difference seems small, but over 20 to 30 years, it can cost you tens or even hundreds of thousands of dollars. Fees are an invisible tax on your wealth. Reason 3. Historical performance. The S&P 500 has averaged around 10% annual returns over the long term. Some years it's up 30%, some years it's down 20%, but over time it trends upward. Buffett isn't promising you'll get rich quick. He's showing you how to get rich slowly and reliably. Reason 4. Most active managers don't beat the index over long periods of 10 to 15 years. If the professional fund managers struggle to do it consistently, why would the average person try? Buffett's genius is recognizing that sometimes the simple path is the smart path. So you're saving 20% of your salary, investing in yourself, and you're ready to put money in an S&P 500 index fund. Now comes the strategy that eliminates the biggest enemy of investing: emotion. Markets spike and crash like a heartbeat. Dollar cost averaging calms the pulse. Automatic, scheduled buys that ignore fear and greed, keeping your plan steady when emotions surge. Dollar cost averaging. This is where you invest a fixed amount at regular intervals, say $840 every month, regardless of what the market is doing. When prices are high, you buy fewer shares. When prices are low, you buy more shares. Over time, this averages out your cost and removes the temptation to time the market. Key takeaway: automate monthly investments and refuse to time the market. Consistency beats intensity. Small, repeated actions compound into life-changing results. Buffett loves this because it removes emotion from investing. You're not panicking when the market drops. You're not getting greedy when it soars. You're a machine, consistent, disciplined, unstoppable. Let's see what this looks like in practice. You invest $840 per month in an S&P 500 index fund. That's $10,080 per year. Assuming an average annual return of around 10%, after 30 years, you'd have approximately $1.9 million from a regular salary. No special knowledge, no day trading, no crypto gambling, just consistency and time. Here's the part where most people fail. Not because the strategy doesn't work, but because they don't give it time to work. Buffett's secret weapon isn't intelligence, it's patience. Slow and steady wins. While others sprint, stall, and panic, you advance one consistent step at a time, month after month, crossing the finish line with calm, patient discipline. He calls it his favorite holding period. Forever. When you invest in an index fund through dollar cost averaging, you're not checking it daily. You're not selling when it drops 10%. You're definitely not selling when it drops 30%. You're holding through recessions, crashes, and recoveries. The 2008 financial crisis, the market dropped 50%. If you panicked and sold, you locked in those losses. If you kept investing through it, you bought stocks at massive discounts and rode the recovery to new highs. The COVID crash in 2020? Same story. The market dropped 34% in weeks. Then it roared back to all-time highs within months. The people who won? The ones who stayed invested, or, even better, increased their investments during the fear. Buffett has a famous quote, "Be fearful when others are greedy, and greedy when others are fearful." When everyone is panicking and selling, that's when stocks are on sale. That's when your dollar-cost averaging buys you more shares for less money. Now let's talk about how to accelerate this strategy beyond the baseline. Buffett would tell you there are 3 accelerators. 3 accelerators ignite compounding. Earn more with valuable skills, save a higher percentage as income rises, and optimize taxes with the right accounts to keep more of every dollar. Accelerator 1. Increase your income. Remember that investment in yourself? This is where it pays off. Every raise, promotion, or side income stream you develop doesn't just improve your lifestyle, it supercharges your investment capacity. If you start at $50,000 and increase your income by just 5% per year through career growth, by year 10, you're earning over $81,000. If you maintain the same lifestyle and invest the difference, you're building wealth exponentially faster. Accelerator 2. Increase your savings rate. As your income grows, resist lifestyle inflation. If you can push your savings rate from 20% to 30% or even 40%, you're cutting years off your path to financial independence. Accelerator 3. Tax optimization. Use tax-advantaged accounts. In the UK, that means your ISA, workplace pension match if your employer offers one, and potentially a SIPP. In the US, the equivalent is maxing out your 401k match and using IRAs. If your employer offers matching, that's literally free money, an immediate 50% to 100% return. This should be your first priority before investing in a taxable account. These tax-advantaged accounts give you either immediate tax deductions with tax-deferred growth or tax-free growth forever. Over decades, this compounds into massive differences. Buffett's strategy is simple, but simple doesn't mean easy. There are landmines everywhere designed to blow up your wealth. Let's talk about what he'd tell you to avoid. Beware financial landmines, high fees, timing bets, speculative tips, and easy debt. One wrong step can derail years of progress. Caution and simplicity protect your future. Mistake number 1. High-fee financial advisors and funds. Some charge 1 to 2% of your assets annually. The difference between 0.03% and 1 to 2% in fees seems small. But over 20 to 30 years, it can cost you tens or even hundreds of thousands. Fees are an invisible tax. For most people investing in index funds, you don't need expensive management. Mistake number 2. Trying to time the market. You cannot predict when the market will go up or down. No one can, not consistently. Every dollar you keep in cash waiting for the right time is a dollar not compounding. Buffett says, the stock market is a device for transferring money from the impatient to the patient. Mistake number 3. Individual stock picking without expertise. Yes, Buffett picked individual stocks and became a billionaire. But he also spent 80+ years studying businesses, reading financial statements, and developing expertise that few possess. For someone starting with a salary today, he explicitly recommends index funds instead. Don't confuse his personal strategy with his recommended strategy for you. Mistake number 4. High-interest debt. Buffett has said he's never borrowed significant money to invest. Credit card debt at 18 to 25% interest rates will destroy any investment returns you're making. Before you aggressively invest, eliminate high-interest debt. Think of paying off a 20% interest credit card as earning a guaranteed 20% return. You won't find that in the stock market. Mistake number 5. Panic selling. The market will crash again. It always does. In your investing lifetime, you'll experience multiple 20% plus drops and probably at least one 50% crash. This is normal. This is expected. This is where fortunes are made or lost based on your reaction. Buffett's advice? Do nothing. Or better yet, invest more. Let's set realistic expectations. This isn't a get-rich-quick scheme. It's a get-rich-certain plan, but it takes time. Time keeps moving. Let your money move with it. Stay invested while the clock turns, and watch the wealth meter climb through steady contributions and compounded growth. If you're 25 years old, earning $50,000, saving 20%, and investing in an S&P 500 index fund with around 10% average annual returns, after 10 years, you'd have approximately $175,000. Not enough to retire, but you're building momentum. After 20 years, you'd have approximately $630,000. Now, you're starting to see the exponential curve. More than half of this is investment returns, not your contributions. After 30 years, at age 55, you'd have approximately $1.9 million. You're now financially independent. You can retire early if you want, or keep working because you choose to, not because you have to. But here's where it gets really interesting. If you worked just 5 more years to age 60, maintaining the same investments, you'd have over $3 million. Those extra 5 years add well over $1 million because compound interest is in full effect. This is the power of starting early and staying consistent. Time is your greatest asset. The younger you start, the less you need to save each month to reach the same goals. Beyond the mechanics of saving and investing, Buffett would emphasize the mindset that makes all of this possible. This is what separates the wealthy from everyone else. Not just what they do, but how they think. Shift from scarcity to abundance. Focus on skills, savings rates, and long horizons. Your habits today create tomorrow's options. Confidence replaces fear when you have a plan. First, think long-term. In a world of instant gratification, TikTok videos, and dopamine hits, the ability to delay gratification is a superpower. Every dollar you invest today is a dollar working for you for decades. That $840 monthly investment isn't just $840, it's potentially several $1,000s in retirement after 30 years of growth. Second, detach money from ego. Buffett doesn't drive a Lamborghini. He doesn't wear a Rolex. He doesn't live in a mansion. Not because he can't afford it, but because he understands that wealth isn't about impressing people. It's about freedom, security, and options. The person driving the luxury car might be drowning in debt. The person driving the Honda Civic might be a millionaire. Third, view market crashes as opportunities, not disasters. When everyone else sees danger, Buffett sees discount prices. This requires emotional discipline and a deep understanding that market crashes are temporary, but good businesses are permanent. Fourth, ignore the noise. Financial media wants you to panic, trade, and react. They need headlines and drama. Buffett reads annual reports and thinks for himself. He doesn't check stock prices daily. He doesn't panic over headlines. He focuses on fundamentals and time horizons measured in years and decades, not days and weeks. Fifth, understand that wealth is a marathon, not a sprint. Buffett is 94 years old. His compounding journey is nearly a century long. You don't need to match that, but you do need to embrace that real wealth takes time to build. Anyone promising you otherwise is selling you something. Knowledge without action is worthless. So let's talk about your specific action plan. What you should do in the next 24 hours, the next week, and the next month. Here's your timeline. Actions for the next 24 hours, 7 days, and 30 days. Simple steps you can execute now to lock in momentum and make investing automatic. In the next 24 hours, 1. Calculate your current savings rate. Take your monthly income minus your monthly expenses, divide by your monthly income. Is it 20% or higher? If not, identify one expense you can cut immediately. 2. Research low-cost S&P 500 index funds. Look at Vanguard's VOO, State Street's SPY, or Fidelity's FXAIX. Compare expense ratios. You want the lowest fees possible, ideally under 0.05%. In the next 7 days, 1. Open a brokerage account if you don't have one. Fidelity, Vanguard, and Charles Schwab all offer excellent platforms with no account minimums or trading fees. 2. If your employer offers matching contributions on your pension or 401k, set up or increase your contribution to capture the full match. This is the only guaranteed return you'll ever get. Immediate 50% to 100% returns through employer matching. 3. Set up automatic transfers from your checking account to your investment account. Pay yourself first. Make it automatic, so discipline isn't required. Systems are more reliable than willpower. In the next 30 days. 1. Make your first investment, even if it's just $100. The psychology of becoming an investor is crucial. Once you have skin in the game, you'll pay more attention and learn faster. 2. Create a simple spreadsheet to track your net worth monthly. Include all assets minus all debts. Watching this number grow becomes addictive in the best way possible. 3. Commit to reading about investing for 15 to 30 minutes daily. Start with Buffett's annual shareholder letters. They're free online and pure gold. Read The Little Book of Common Sense Investing by Jack Bogle. Learn continuously. Let me leave you with one final concept that ties everything together: the compound effect. Albert Einstein allegedly called compound interest the eighth wonder of the world. Buffett calls it his best friend. Here's why it's so powerful. In the early years, your returns seem modest. You invest $10,000, it grows to $11,000. You made $1,000. That's not life-changing money. So many people quit here. They don't see the magic yet. Compounding starts like a fragile seedling, almost invisible. Protect it with consistency, and over time it becomes a sturdy tree, producing returns year after year without effort. But as your account balance grows, so do the dollar amounts of your returns. When your portfolio hits $100,000, that same 10% return is $10,000. When it hits $500,000, it's $50,000. When it hits $1,000, it's $100,000 per year. In the later years, your money makes more money than you do from your salary. That's when you've achieved what Buffett calls financial independence. Your money works harder than you do. The strategy Buffett would use if starting over today isn't complicated. It's actually beautifully simple. Live below your means. Save 20% or more. Invest in yourself first. Put the rest in low-cost S&P 500 index funds. Use dollar-cost averaging. Hold forever. Ignore the noise. Stay patient. Repeat for decades. This isn't sexy. It won't make you rich next month, but it's proven. It's reliable. And it works. The difference between where you are now and financial independence isn't luck, inheritance, or genius-level intelligence. It's discipline, consistency, and time. Buffett proved it. Millions of quiet millionaires prove it every year. And now you have the roadmap. The best time to start investing was 20 years ago. The second best time is today. Not tomorrow. Not next month when you have more money. Today. Your 55-year-old self is looking back at you right now. They're either thanking you for starting today or regretting that you didn't. Which version of your future self do you want to meet? If you found value in this breakdown, hit that like button. It helps more people discover this life-changing strategy. Subscribe for more content on building wealth, financial independence, and living life on your terms. Now stop watching videos and go open that brokerage account. Your future millionaire self is waiting.